Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello and welcome to the first installment of our 2024 India Market Outlook podcast mini-series, which outlines the key investment views and how investors should be positioned going into 2024. My name is Ravi Singh. I'm the Chief Investment Strategist at Standard Chartered Bank India. I'll be the host for this podcast. Now, we've just released our 2024 Outlook titled Sailing with the Wind, and today I will cover the headline views for annual outlook and our foundation allocations. In the subsequent podcast, of course, we will look into more details in each asset class: equities, bonds, FX, and commodities. So let's start with the macroeconomic outlook. We have witnessed significant shifts in global sentiments throughout the past year, more importantly in the fourth quarter of 2023, with global central banks indicating a peak in the policy rate cycle as the outlook on inflation improved. Indian economy has endured the impact of rapid monetary policy tightening better than major economies. Domestic GDP growth has stayed above trend and ahead of peers, while inflationary pressures has stayed anchored around the RBI's inflation target range. Government capex, coupled with incentives to manufacturing and infrastructure sectors, has driven a pickup in private investments. These are strong tailwinds for the corporate profit cycle, which remains on track to be the best in over a decade. In our base case scenario, we expect this macroeconomic scenario to be the prevailing wind as we enter 2024. In our view, domestic growth in the first half of 2024 is likely to get a boost from an acceleration in consumption demand through election-related spending. Investment growth could pick up in second half of 2024 with an acceleration in private spending as the new government's policy priorities become apparent. In addition, India is relatively less exposed to global macro risk emanating from slower global growth, still elevated interest rates, greater geopolitical uncertainty given its large domestic growth base and improving external position. On inflation, the outlook has improved compared to the past year. Though a surge in oil prices and weather-related uncertainties can still create inflation risk, ensuing disinflationary momentum in core inflation and government's readiness to intervene on the supply side could help contain the impact of volatile food and energy prices. In our assessment, the RBI is likely to maintain a pause in the first half of 2024 on policy rates given the growth inflation dynamics. As disinflationary pressures build over the first half of 2024, we expect the RBI to cut rates in the later half of 2024. Nevertheless, the rate easing cycle is likely to be a shallow one as strong domestic demand and resilient growth impulses creates a floor on core inflation. However, this view could be tested if domestic growth slows or major central banks resort to further tightening should inflationary pressures resurface. Now, coming to our foundation allocations. Against the backdrop of strong domestic macro fundamentals and a weakening global growth outlook, we believe in 2024, investors would need to not only balance the evolution of this macroeconomic scenario, but also find attractive risk-reward opportunities. For foundation allocations, our key overweight is equities, where we expect the positive momentum to extend in the first half of fiscal 2024, driven by the following factors. First, superior profit cycle. India's earnings remain resilient post a decade-long down cycle from 2011 to 2020. As per Bloomberg consensus estimates, Nifty Index EPS is expected to grow by 14% and 16% in fiscal year 2024 and fiscal year 2025 respectively. This means the overall EPS growth for the period fiscal year 2020 to fiscal year 2025 could be in the range of 18%, making the current cycle as the best since 2004 and 2008 period. Second factor, of course, is the valuation, which appears more reasonable. India's market capitalization has crossed the USD 4 trillion mark in 2023 as domestic equity indices scale new all-time peaks. Despite the strong gains, Nifty Index 12-month forward price to earnings ratio is at the range of around 19.8 times, which is lower than the peak of October 2021. In our view, Indian equities valuation premium to peers is justified given superior GDP growth and earnings delivery. The third factor is the low foreign investor positioning and strong domestic flows. Despite a strong foreign investor flow in the range of $18 billion YTD 2023, foreign ownership of BSE 200 index market capitalization is at a decadal low of 18%. Domestic flows remain strong on greater adoption of financial assets and robust systematic investment inflows into mutual funds. The fourth factor, of course, is pre-election optimism. A historical analysis suggests that equity markets' performance gets a pre-election boost. Within equities, our key overweight is large-cap equities, given better margin of safety in terms of earnings and valuations, and stronger balance sheets to cushion against an adverse macro environment. Coming to fixed income, we expect bonds to outperform cash. In absolute terms, bond investors were reasonably compensated for staying invested in 2023, as higher yields at the start of the year translated into strong realized returns. We expect bonds to outperform cash in 2024 and have downgraded cash to underweight. This view is supported by the following factors. First, of course, is the attractive carry as bond yields continue to trade above their long-term averages. Second is the increased likelihood of policy easing by the RBI and global central banks in the second half of 2024. And third is the improving demand outlook for India onshore bonds following India's inclusion in Global Bond Index starting in June 2024. Within bonds, our highest conviction is on medium and long maturity bonds, where we find the risk reward attractive. Our base case scenario is likely to result in enough downside on bond yields for it to beat cash yields. Further, we also see bonds as an attractive hedge against a scenario where domestic growth slows because of a hard landing in developed economies, in which case the fall in yields and rise in prices is likely to be more significant. We also prefer high quality or AAA rated corporate bonds over government bonds. The absolute yield on high quality bonds remains close to its recent peaks, requiring only modest price gains to beat cash and government bonds. Further, we expect corporate bond spreads, or the spread that they offer over government bonds, to narrow amid steady demand for high quality bonds and strong corporate fundamentals given robust profit growth outlook. While we remain positive getting into 2024, but we remain mindful of things that could go wrong, our positive view on equities, at least in the first half of 2024, may be at the risk if economic growth or earnings delivery falters, either for domestic reasons or a hard landing scenario in major developed economies. Geopolitics is also a potential risk, especially given 2024 is likely to experience an unusually busy election calendar. As market consensus leans towards continuity in government in the upcoming general elections in India, a surprise outcome could trigger market volatility in the near term. History shows us that something breaks when rates are high. Finally, we would remain on watch for any potential policy misstep of being too hawkish or too dovish.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.